What's going on, everyone? Welcome to the Hustle or Stay Basic channel, the Invest or Stay Basic segment. I'm your host, KG, at KG the Hustler on Instagram. Recently, I finished reading a book and I posted a little survey on Instagram asking if people wanted to see a video summary. And the results were definitely yes, please. They wanted to check it out. So we got the book, Beating the Street by Peter Lynch. And I'm going to provide you guys a video summary and some of my key takeaways. If you got value out of this video, I'd appreciate it if you liked it for the YouTube algorithm and subscribed for more content like this. Peter Lynch is a legendary investor. He managed a Fidelity Magellan fund or a mutual fund between 1977 and 1990, and he achieved an annual return throughout those years of 29%, which made it the best performing mutual fund in the world. He outperformed Buffett by an average of 9% a year. That is a massive difference once compounded. What's even crazier about this feat is the SEC, or the Securities and Exchange Commissions, mandated that funds can only hold up to a maximum of 5% of a company. So this made it even more challenging, and yet he still outperformed Buffett, who was allowed to hold more than 5% of any one holding. During the period of 1977 to 1990, he went from managing $18 million to $14 billion as his fund grew in popularity. Another thing that makes this guy so legendary is he was managing 60 stocks at one point, and it got all the way up to 1,400 stocks as Magellan grew. Can you imagine knowing the insides and outs of 1,400 companies at a time? Like, that's absolutely nuts. What I love about Peter Lynch particularly is he doesn't speak in business jargon. He speaks like normal everyday human, and he has humble beginnings. He lost his father at a young age and kind of had to hustle or stay basic to become who he is. And I really appreciate his story and what he does for the retail investor. Now I'm going to go into some of the principles, some of the key things I learned, and some of the things he wants you to take away as a reader, or I guess a watcher of this video. Throughout these books, he has a bunch of these Peter's principles, and they're kind of funny, and I called out this one in particular because I thought it was great. So the principle is never invest in any idea you can't illustrate with a crayon. And basically what Peter Lynch is saying is know why you own something and what they do. And he has a great story in his book where a grade 7 class, and I mean this is a pretty cool grade 7 class that their teachers letting them pick stocks, picked some stocks that outperformed the S&P 500 by 3x over a period of 2 years. And the point of this is that retail investors have a huge advantage, and you'll tell by some of the companies that these grade 7 kids picked. They picked Walmart, Nike, Walt Disney, Pentec, which was a company of a pen that they really liked that could highlight on one end and write on the other. PepsiCo, Gap. I mean, these are companies that the retail investor knows about ahead of Wall Street, yet we don't invest in them. We invest in complicated companies and complicated businesses like a utilities company or oil company. The reason I love this principle is because it's so simple, yet many investors don't do it, and I apply it every day. And all the companies that I pick, I only invest in companies that I understand. I don't try to go outside my circle of competence. Second lesson that I got from this book is hold no more stocks than you can remain informed on. Now, Peter Lynch is just legendary because you could stay informed on 1,400 companies, but the average retail investor like you who's watching the video and myself, we got things to do. We're busy. We can't keep up with 30, 40, 50 companies at one given time. So he says, you got to keep up with quarterly reports, investor calls, all the latest news, earnings, press releases, stuff like this. So only investing the amount of companies that you can keep up with. In my portfolio, I think I hold 6 or 7 stocks, and that's quite a bit for me, and I'm still able to keep up with it. A lot of retail investors try to create their own ETF in essence, like holding 1% of a stock or 0.3% of a stock. I mean, this is a huge advantage for you as a retail investor to just hold a small amount of positions and watch them grow. And if you don't like them, change them. I mean, you don't need to hold 30 positions. I know a lot of people might disagree and say, hey, I can't even say the word. Diversification is key because you want to avoid risk of losing money. But I mean, as a retail investor, you're not managing anyone's money. You're managing your own. And holding 6 stocks, 5 stocks, equal weight. If one of them 10x's and the rest are lousy, you still 3x your portfolio. So I really do like this lesson. Another quote from the book I liked is, A successful stock picker has the same relationship with a drop in the market as a Minnesotan has with freezing weather, or Canadian, I guess. You know it's coming and you're ready to ride it out. And when your favorite stocks go down with the rest, you jump at the chance to buy more. In a chapter called The Weekend Worrier, Peter Lynch talks about these annual Barron's magazine meetings he would have with a bunch of mutual fund managers, and basically all of them were predicting doom and gloom all the time. And he said if you had listened to them, you'd probably sell out of your positions, but by investing regularly, buying the dips over the long run, 20 years, 30 years, you'll be fine. So the message he's trying to tell you guys is, invest regularly, expect a downturn, but just ride it out. I experienced this situation during the March crash where one of my biggest positions dropped 50%, but I just continued to invest. I continued to buy the dip, and I just recently sold that position at almost a 70% gain. So, just investing consistently does pay off. Another lesson in his book is, he says, you've got to go into places where other investors and fund managers fear to tread. And I got a perfect example with this during the March crash. I heard a lot about retail is dead. All these retail stores and outlets are going to die. E-commerce is taken over. And there was a company called RioCan. It's a REIT, a real estate investment trust, and it was down 42%. But when I looked at the numbers, the funds from operations were only down 24%. I thought it was way oversold, so I bought the stock and recently sold it at a 46% gain. That's definitely just applying his lessons here. And another example I have, and by the way, both of these are from the email group. I used to do an email group before this YouTube channel. If you were part of that email group, you would have definitely had some great gains. But Husky Energy, I look like no one was investing in oil. Oil prices were so low, people were staying away from it. And I looked at Husky Energy and I said, well, let's compare the market cap to another oil industry company. Let's look at the EBITDA, the long-term debt, and I said, you know what, Husky should be worth anywhere around $5 to $6, and eventually it actually got bought out by Synovus. And if you sold, last week, you would have been up 63% on the position. So, Lynch is really right in saying, hey, go into these areas and do your analysis. Don't just buy because the stock's in an industry that everyone's afraid of. Do your analysis, look at the numbers, and I'm sure you'll find some deals like I did. In a chapter called Cyclicals, What Goes Around Comes Around, Peter Lynch says, buying a cyclical after several years of record earnings and when the PE ratio has hit a low point is a proven method for losing half your money in a short period of time. And basically what he's saying is, chemicals, precious metals, automotive, airlines, like these are all cyclical industries, and when the price to earnings ratios are so low, that means the company's performing great and there's eventually a downturn going to come. And he's saying you actually want to look at the other way when the price to earnings ratio is really high and the company has been missing earnings year over year, quarter over quarter. You might be an opportunity to buy on the low end of the spectrum to go through that whole cyclical rise. In this book, he talks a lot about winning by investing in Chrysler, GM, and Ford, and watching for new car buying cycles and analyzing pent-up demand for vehicle owners or people who want to buy vehicles. I put Kirkland Lake Gold here because I think it's a cyclical as well, and I think the demand is really low right now, but there will be demand in the future, and if you're buying now, you'll definitely benefit from that. In another chapter called 6-Month Checkup, he talks about going through these 3 questions in your head. I own X company. Has the story gone better? Has the story gone worse? Is the story unchanged? And, if it's gone better, maybe you want to increase your position. If it's gone worse, maybe you want to take some profits off the table. If it's unchanged, maybe you want to go look at another stock to buy, or maybe you want to increase your position. These are great questions to ask yourself every 6 months and, rebalance your portfolio. In this book as well, he talks about foreign stocks and, foreign companies not having many analysts, and that creates an opportunity for those who are, digging for treasure, searching for deals. And he talks about, traveling to Sweden, and the only analyst in Sweden doesn't cover Volvo. So he was able to buy Volvo at a very cheap valuation and make a lot of money off of that. So, don't hold yourself to just the North American markets. Look at other markets as well. I also like this sentence that he says here. The best stock to buy might be the one you already own. And basically what he's saying is like, if you're searching for deals and you can't find any, look to your own portfolio. Maybe you want to increase the position of one of the stocks you already hold. And, if you've seen my video on the 2 undervalued stocks that I just bought in late March, you'll see that that's exactly what I did. I couldn't find really any great deals, so I just doubled down on some of my positions because, they were still undervalued. He also mentions, in business, competition is never as healthy as total domination. I'm always on the lookout for great companies and lousy industries. When an industry gets too popular, nobody makes money over there anymore. And he brings up a good example of Cooper Tire, which provides replacement tires to used cars. He said there was a battle going on with Michelin, Bridgestone, and Goodyear. And Cooper Tire was just kind of there just saying, hey, I don't want to get into the new car industry. I'm just going to be the replacement tires. And they were doing great. They were growing, but they had total domination over the used car tire replacement industry. So he said, don't follow the fads, don't follow the hot stocks, because competition isn't great when you're trying to buy stocks. Go to the companies that are just totally dominating, and he mentions Cooper Tire in that instance, and I think that's a great lesson to take away. By the way, Cooper Tire was a 5-bagger firm, which means he got 5x his return on investment. So it might not be a sexy stock, but he definitely made some money on it, and there's definitely opportunities out there for everyone else. Other cool things with this book is, Lynch got a bunch of stories in here, and they're pretty funny. I mean, one of them I really enjoyed was him sitting at Supercuts, which is a haircutting or barber salon, and he's just sitting there with the annual report and just watching the foot traffic, seeing if people are happy with their haircuts, trying to kind of see if he wants to invest in the company. And I thought that was cool. He talks about his wife and his daughter being obsessed with The Body Shop. So when it IPO'd, he bought it and he made a lot of money on that one. He talks about his children always wanting to go to Chili's for dinner, but he kind of regrets not buying it. He's like, wow, I was such an idiot for missing out on that. It was right there in front of me. And also just his work ethic. He used to work 6 days a week, and he talks about having 3 feet worth of annual reports on his desk, and you just go through it. I mean, imagine 1,400 companies you got to know the inside and out of. And he also talks about stories of calling CEOs daily, asking for an update on like, hey, how do earnings look? How does X plant look? Are you guys going to acquire anyone? Stuff like that. So, I mean, just a crazy work ethic, and he definitely got what he deserved out of it by all his returns. So, I mean, the 2 big advantages you have as a retail investor based on this book that I got out of it is you're a consumer of products. You will know if a product is good before Wall Street even gets it, their hands on it. So, if you're having Chipotle and it's the 50th restaurant in Canada and you see the stock price undervalued, before Wall Street that, hey, Chipotle is going to blow up. I really like this product, and a lot of people do too. The second advantage you have is, Peter Lynch wrote this book in the 90s. He used to calculate all his ratios by hand, pull out his calculator, try to figure out, what's the price to earnings? What's it been for the last 5 years? All that data is available to you today online. I mean, that's a huge advantage. It saves a lot of time. You can just imagine the amount of time Peter Lynch put into his calculations, and you have it as fingertips. So I think that's a great advantage for you. Now, before I end this video, I want to share my biggest takeaway from this video, and it kind of changed my investing perspective, and I'll tell you why. He says, time is on your side when you own shares of superior companies. You can afford to be patient. If you didn't buy a Walmart within the first 5 years, it was still a great stock to own in the next 5 years. And what he's saying there is you don't have to be the first one to buy that stock when, revenues and earnings are not proven. You can wait for a company to prove themselves out and then buy into it. And the best example I can think of is Warren Buffett, where he bought Apple in 2016. And he the iPhone came out in 2007. So you could say he was late to the game. I mean, if you looked at that chart, you could have been like, oh yeah, he totally missed the train on Apple. But, he still had a 400% gain from Apple. So you don't have to be the first one there. You can wait, evaluate, and then buy and still do really well in the stock market. So I think that was the biggest takeaway from me. So you don't need to speculate too much. You can be patient. So this is a great read. I mean, lots of stories about different stocks. I mean, he mentions probably 100 different stocks that he bought in here, why he bought it, what the situation was in the 70s and the 80s and 90s. So it is a little dated, but I mean, the principles still apply to today. He actually has something at the end, like the last chapter called Peter Lynch's 25 Golden Rules. I think that alone is worth the read. So I'd highly recommend you guys buy this book. So that's all I had to say about this book. If you enjoyed the video, like I said, subscribe, like the video. Really appreciate it. And I'll check you guys later. See ya. Bye.